Hey there YouTube. So in this video I wanted to cover the substantial presence test for non-resident taxpayers of the United States. So what is it? What does it mean if you meet the test, and what do you have to do if you trip over these kind of rules? So in the United States, when you're an individual, you're a U.S. tax resident if you meet one of the three standards. So the first one is, are you a U.S. citizen? Okay, that's the big one. If you're a U.S. citizen, it doesn't matter where you live, you're always considered a U.S. tax resident. And that includes dual citizens. So if you're a citizen of Germany and you're also a citizen of the United States, but you've lived in Germany your whole life and you've never even visited the United States, you are still a U.S. tax resident. That's the joy of being a U.S. citizen. The second one is U.S. green card holders or permanent residents. So if you get a green card in the United States, you're taxed just like a U.S. citizen is, right? So you are now a U.S. tax resident. You're subject to tax on your worldwide income. So you're filing Form 1040, you're paying taxes, doing all the disclosures, everything that a U.S. citizen would do. The third bucket is a non-resident that's physically in the U.S. for a certain number of days, and they're there enough days to meet what's called the substantial presence test. Now, if you meet the substantial presence test, you are a U.S. tax resident. So you're subject to tax just the same way the U.S. citizens or the U.S. green card holders are. So you're filing Form 1040, you're paying tax on your worldwide income, you're filing foreign bank account reports if you have any foreign accounts or foreign financial assets. So there's a lot of disclosure and tax obligation that goes into meeting this test. So what is the test? To meet the substantial presence test, you need to be physically present in the U.S. on at least 31 days during the current year. So you got to hit at least 31. And then you have a 183-day window, but it's not looking at just the current period. It's a 83 days, counting up portions of the days you were in the U.S. going back 3 years. Okay, so this is the actual standard that's in the code. So 183 days during the 3-year period that includes the current year and the 2 years immediately before that. So you count all the days you were present in the current year, and then you go back 1 year and you count 1/3 of those days, and then you go back the second year and you count 1/6 of those days. So in effect, what's happening here is you're not just looking at the current year, you're looking 2 years back to see if you meet the 183-day total. And this is important because a lot of people will see the 183-day and think, oh, I could be in the U.S. for as many days as I want up to 183, and then I'm good. I won't meet that substantial presence test. And that's not true. That is not how the computation works. So let's look at this example here below. You're physically present in the U.S. on a tourist visa, right? So you're not on a work visa, you're just in the U.S. on a tourist visa. You spent 150 days in 2020 and in 2021. So 300 days total, 150 year one, 150 year two. So if you meet the substantial presence test for 2021, you would count the 150 full days you were in the U.S. for 2021, and then you count 50 days for 2020, right? So 50 days, 1/3 of 150 in 2020 is 50, right? And then in 2019, you weren't in the U.S. at all. So that's just 0. Okay, so under this standard, you have met the substantial presence test, right? Because you're 150 days in the current year, you add 50 from the prior year, you're at 200. 200 days is well over that 183 mark, so you meet the substantial presence test for 2021. You are a U.S. tax resident. Now, the way the math works, the only way to truly make sure you don't become a U.S. tax resident at all is don't spend any more than 120 days per year. Okay, so if you do 120, 120, 120, and you just never go over that amount, the way that this math will work, you'll never hit the 183, right? So if you have 120 in the current year, and then you take 1/3 of 120 in the prior year, 1/6 of 120 in the 2 prior years, when you add all that up, it's going to be under the 183 mark. So when I advise non-residents that have to travel to the U.S. for work or for vacation, I tell them, look, you can come to the U.S. and you can do some work, you can have holiday here, but really make sure you're nowhere near that 120 mark. If you go over, then we start to get in that territory where you might inadvertently trip over these rules and become a U.S. tax resident. So you definitely don't want to do that. Okay, so that covers it. And I guess the last thing I'll just touch on is just to reiterate, if you meet that substantial presence test and you're a U.S. tax resident, you're a full-blown U.S. tax resident now. So you are filing a Form 1040. You're going to report all of your income from everywhere. You're paying tax in the U.S. If you have foreign financial assets, you need to do 8938 disclosures, FBAR filings. If you own foreign corporations, you probably need CFC. You have CFC issues, so you need to do 5471s. It is a mess. So if you're a non-resident and you need to come to the U.S. every once in a while, really, really, really make sure that you don't trip over these day counts. It's very, very important. So that covers it. Hope that was helpful. If you have any comments or questions, please leave a comment below in the video. Happy to answer any that come up. And thank you again. I hope to see you again soon. Bye.